In this lecture, we're going to step inside the world of corporate accounting to explore a key strategic choice that parent companies face after an acquisition. We'll be looking at the internal playbooks they use to account for their investments in subsidiaries. This is a crucial topic that builds directly on our last chapter. In 2017, Amazon acquired Whole Foods in a multi-billion-dollar deal. Now, to the outside world, to investors and customers, we see one massive, consolidated company. But behind the scenes, Amazon's accountants face a critical question every single day. How do we track the performance and value of our investment in Whole Foods on our own internal books? Today, we're stepping into the shoes of those corporate accountants. After the deal closes, their work is just beginning. They need a system to monitor this massive investment year after year. Let's explore the playbook they can choose from. For its own internal record keeping, a parent company must select a method to account for its subsidiary. There are three primary methods, or playbooks, as we'll call them: the equity method, the initial value method, and the partial equity method. Now, here is the most important concept for this entire chapter, so I want you to lock this in. The choice of internal method does not change the final consolidated numbers that are reported to the public. It only affects the parent company's private books. Let's break down the first playbook. The equity method is the most comprehensive approach. I want you to think of it as the real-time scoreboard. Its core concept is that the parent company's investment account is constantly adjusted to reflect the subsidiary's real-time performance. Here's how it works. When the subsidiary, like Whole Foods, earns net income, the parent's investment account increases. When the subsidiary pays dividends back to the parent, the investment account decreases. It also includes other complex adjustments, like amortization, which we will discuss later. The main advantage: it provides the most accurate, up-to-date picture of the subsidiary's value on the parent's internal books at any given moment. It's like a live, constantly updating scoreboard. Next, we have the initial value method. If the equity method is a real-time scoreboard, think of this one as the cash-only scoreboard. The concept here is simplicity. The investment account remains on the parent's books at its original cost. The only thing that matters is cash received. The investment account itself stays at its initial value, and the parent only recognizes income when it receives a cash dividend from its subsidiary. Its advantage is clear. It's simple to apply and perfectly reflects the actual cash flow from the subsidiary to the parent. It's a straightforward, no-frills approach. Our third playbook is the partial equity method, which you can think of as the hybrid approach. It's a mix between the first two. Like the equity method, the parent's investment account increases for the subsidiary's income and decreases for dividends, but it saves time by ignoring the other, more complex adjustments like amortization that are required under the full equity method. So its advantage is that it provides a good balance. It's easier to apply than the full equity method, but still gives management a much better performance measure than just tracking cash dividends. Now we come back to the golden rule of this entire topic. I'm repeating this because it's the concept that students find most confusing, but it's crucial. No matter which of these three methods the parent company uses for its own internal books, the final, published, audited, consolidated financial statements that go out to the public will be exactly the same. Why? Because all the differences between these methods are completely eliminated during the year-end consolidation process. It doesn't matter if the coach uses playbook A, B, or C during the season. When it's time for the championship game, the public 10K report, the final score on the board will be identical. The worksheet entries we learn will ensure this. So, Let's quickly recap the three playbooks. The equity method provides the most accurate real-time view as the investment is constantly adjusted. The initial value method is the simplest, focusing only on cash dividends. And the partial equity method is the hybrid, offering a good balance between the accuracy of the equity method and the simplicity of the initial value method.